Jeb's got the listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up a spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Welcome to another Wednesday of the Educated HomeBuyer Live with Josh and myself, here to update you on the economy, talk about mortgage rates, talk about housing, have some fun while we're doing it. Josh, welcome back.
I nominate this, Jeb, as the longest Wednesday ever. I realized when I got back to my desk, it was already 5 o'clock. I'm like, I am late for the show. And I look up and thankfully there was 18 seconds. So I only got to hear 18 seconds of the greatest song in
number one, Billboard's number one.
Billboard's number one. I only got to hear
it's on the top of the chart. It's going to probably stay there. So, you know,
I should set it as my ringtone. Would that be vain to have your own song as your ringtone?
Would it be crazy if we put that in Spotify and let people download it?
We should. We should.
No, in all seriousness, prayers for Charlie Kirkland, his family, his wife, his kids. Super sad stuff going on out there. And yeah, just wanted to take a moment and mention that. Josh, since last week, we've had mortgage rates actually move down in a pretty meaningful way, about 0.25% or so. I know we're going to talk about it. We're going to talk about what got us there. We're going to look at some charts as we always do. But is there anything you want to touch on before we dive into it?
No.
Just simple answer. No, he doesn't.
I'll stay away from it. No one wants to hear what I have to say right now.
No one wants to hear what Josh has to say. That's what he's telling me. All right. So let's do as we always do then and start with inventory. So inventory actually dropped this week, kind of in a meaningful way. But that said, we're still up 20.2% from this time last year. Last week we discussed inventory dropping because of the Labor Day holiday that was, counted into that data, and that was going to be reported. But I think the consensus is that the drop seemed to be a little bit higher than most people wanted. And it actually fell the same week as last year. And so the data on a chart should look pretty similar. But if you look at last year, it kind of flatlined during that week. This year we saw a decline. So the question a lot of people are asking is inventory peaking for the year, or is it going to continue to decline rapidly from here, or is this kind of an anomaly in the data? So going to continue to watch it, update you guys, but something to pay attention to for sure, because demand is picking up and we need inventory to kind of stay there. Otherwise, you're going to get a little bit of craziness coming back in the second half, the last quarter. Pretty much.
Jeb, we are putting loans on the board that will close in October. And I look up and I go, that is Q4. We were just talking like it's January. This is going to be an interesting year. Let's see how it plays out.
Signed a listing agreement that expires in March of next year. And I'm like, for 6 months, I'm like, what are we doing? Like, how did we get here? But anyhow, inventory, Orange County, Huntington Beach, charts again, a little bit skewed here, a little bit wonky because of Chat GPT just going bananas on me and just doing whatever they want to do. Either way, we saw Huntington Beach actually declined to 4,730 homes. I actually forgot to put the percentage. I didn't move it the chart to the back of the screen there, so you can't see it. But it dropped just over 1%. Huntington Beach sitting at 274, dropped about 6% or so from last week. So we've got inventory dropping, as you can see on those charts. My guess is probably going to continue from here as we head into that fall winter market. Even if rates come down, I don't know that you're going to see inventory shoot back up anywhere above those high levels that we saw. Again, another look at active inventory. Just the reason I like this chart is because it does go back, shows 2017, 18, and 19. Those are the three lines above 2025, just for some context there, outside of the craziness of the pandemic. This is just another look at active inventory. This was back in August, first look at August inventory coming from Calculated Risk. And the reason I threw this in there is just to give you some, some context with different areas across the country and where inventory stands versus 2019. You can see Denver, Las Vegas, Nashville, Northwest area of the U.S. and Portland all up compared to 2019. And you have like Raleigh and San Diego still down when looking at that inventory compared to 6 years ago at this point, Josh. New listings, we saw new listings, 65,000 new listings, representing a 2% increase compared to last year. So still positive there that we've got some sort of, positive note on new listings data. Not going to really well, again, another chart, new listings, calculator risk. My watch is just going bananas over here. It's buzzing.
You got to do not disturb everything when we go on.
I didn't even put do not disturb on my phone, so it's probably buzzing as well, or it definitely is buzzing. Just compared to 2019, all areas are down with new listings. Again, not really a surprise just because of where rates are, that sort of thing at the moment, just less people coming to the market.
Jeb, before you move on, that was interesting to me because those numbers are down massively. So if it's not mathing for you at home, how can we have new listings down 15 to 30%, 10 to 35%, depending on where you're at, and still have more active inventory? It's because less demand, less homes because of the affordability issue, less homes. So more homes back up on the market, even though less are being listed.
Yep, exactly. Weekly pending sales, total pending sales looks very similar to last, year, still positive, not really a lot to report there. Percentage of properties with price reductions saw a slight tick down at 41.5% versus 42%. Again, expecting that number to flatline, probably go lower. It looks like we're going to converge with 2022 and probably 2024 here really soon. As inventory declines into that fall winter market. Josh, we talk about spreads every so often here. One of the things that, it's becoming a kind of a topic of conversation with the Fed lowering federal funds rate here probably next week is the expectation. And, some of the other data reporting in a way that would benefit mortgage rates. People are thinking the spread might compress even further, but at the moment, sitting at, I think, about 2.3%, compared to 2.5% back in 2023. So a noticeable decrease there.
As of today, we're at 2.28. I've got a couple of slides in here that show it in a slightly different way and a cool little angle at it. So when we get to that, let's circle back and go a little deeper.
Yeah. So let's jump in there. So the big news last week, Josh, was not only non-farm payrolls coming in with disappointing numbers, but we also saw some down revisions as well.
Yeah. So if you look at this, the trend is pretty clear. That red line shows you a lot of noise. There's seasonality. So these numbers are always going to jump around. 2 months ago, after the revisions, we had actually a negative figure. What did we have? Ended up with 22,000 jobs, Jeb, and they were expecting like 75,000. So 50,000 less. any way you cut it, that is weakness in the labor market. The big news we had earlier this week that got much larger headlines was not in any way unexpected, was the QCEW report, where they go back and with the benefit of time and more reports and more data, and they revise this. So we knew going through last year, this is kind of important, Jeb, because people want to ask, well, how likely are we to see what we saw last year, that the Fed cut 100 basis points across 3 meetings and we saw rates go up? Why did rates go up? Because we were getting really hot jobs reports, and we're like, the labor market's heating up, inflation might be picking up. So the market started trading off of that. And in reality, we had, due to the birth death ratio, and that's not the birth death ratio of people, it is a number, an imputed number that the Bureau of Labor Statistics uses to figure out how many businesses are going out of business, going under, and how many are being created. And inflection points, they always miss to the wrong side. They overstate when we're at the end of a labor expansion, and they understate at the early part. So at the early part of COVID, it was really understating the jobs that were being created. And here at the end of that boom, it's overstating. So we had 911,000 jobs that were claimed to have been created in the jobs reports over the previous year. Poof, gone. So
Disappeared.
during that time frame, we were averaging 147,000 job creations. After these revisions, 71,000. And I showed these numbers probably 6-8 weeks ago, Jeb. Replacement level right now is figured at about 70,000 jobs. We need 70,000 jobs to keep the unemployment rate stable. So that's about where we've been, and we've seen that unemployment rate stable over the last year. So the numbers work out over the long haul. There's nothing nefarious about this. The government's not cooking the books. It's a massive economy, and it takes a long time to get accurate numbers. Something interesting, a few people have asked, well, hey, we got that number yesterday, and yesterday mortgage rates were worse. Why would that be the case? Because this is old data. It only goes through, I want to say, March.
Yeah,
so
April through March.
Through March. We're at the end of the year. This is old data. And Powell himself in Jackson Hole a couple weeks ago, he said data available to date suggests that the level of non-farm payrolls will be revised down materially on September 9th. So he didn't have the exact numbers, but they had some preliminary numbers, and they knew this was coming. The markets knew this as well. So nothing super shocking there. We got PPI today, and this one was shocking. You see the little red box there showing an outlier. If we show that green trend line, PPI had been trending down nicely. This is the producer price index, the prices that wholesalers charge for goods before they become consumer goods that you buy. That red box was last month. It was super hot, and we got a super cool number today. So we'll see going forward which of those is more accurate. If you annualize the last 2 months, it's still at like 3%, 3.6% annually. So that's not necessarily good, but if you throw June in there, it normalizes out to a pretty normal number. So again, we will see. We'll see how this plays out as the tariffs go. But the underlying implication there with this, Jeb, is that the wholesalers and the producers at certain points in this equation are having to eat some of these tariffs. We will see how that plays out over the long haul. Tomorrow, we get a very important number, the Consumer Price Index. This is the nowcast from the Cleveland Fed. They are predicting we will hit 2.84 on that figure, the headline CPI, and 3.06 for the core CPI. The economic forecast, the consensus is 2.9. Which would be up from 2.7 to 2.9. If the Cleveland Fed is right and it's 2.84, that will round down to 2.8. If we get that, we'll probably see a continuation of the improvement in rates. If it bumps up to the 2.9, then that's more than kind of what the market is expecting. And the core, again, market's expecting 3.1, Cleveland Fed at 3.05 or 06. I can't even really see it there, but these round up and round down. So it'll be interesting. We're right there on the verge of either getting a mildly pleasant surprise or a mildly unpleasant surprise. Like to look at the underlying data. Truflation has a high correlation to CPI over the long run. This is not in any way projecting that we're going to see this tomorrow or that it would come out that quickly, but 2.04 yesterday was 1.99. A week ago was 2.02. So in their measurement, they're not picking up any of this tariff-based inflation in the broad economy yet. So what is it telling us about what the Fed's going to do? There is a 100% chance that they will cut on the 17th. 92% chance of a quarter point cut. 8% chance of a 50 basis point cut. I would be shocked if they did 50 basis points. So let's look at it here. 92% chance there for a quarter point. 85% chance that the next meeting we get a quarter point if we didn't get a 50 basis point cut, and then a 72% chance that we get another quarter point cut at the three remaining meetings of the year. So very likely that they're going to go quarter across the rest of the year. I had a really good conversation, a really good question from a listener yesterday, Jeb. We were doing a Zoom call, going through his situation, and he said, okay, I get it that September is already priced in, but now they're thinking they're going to cut more later in the year. Is that already priced in? Are you already seeing that in rate sheets? So this isn't necessarily the rate sheet, but this is the futures market where investors are looking at this and saying, pretty much an 85% of another quarter point cut and 72% cut of another quarter point cut are priced in. So we need continued negative news that leads to the belief that we're going to get cuts and maybe more cuts at a more rapid pace before we see a lot more improvement. We could still see this gradual glide down in interest rates until those all hit 100%, 100%, which they normally don't hit until right before that meeting. But we'll see how it all plays out. So Jeb, you had mentioned the spreads. I wanted to take a look at this chart because this goes all the way back to 2016. So look at the left side, all that band there that is the recession at the very beginning of COVID. So pre-COVID, that 4.5-5 year time frame, at the low end, we were about 1.4 at the spread between treasuries and mortgages, and at the high end, about 2%. So it spiked at the beginning of COVID. It plummeted and actually went to the bottom of that range to about 1.3, which is about the lowest it's been in the last 20, 25 years before this big run up as rates started shooting up. So from that peak where we were at like 3.1, 3.15, we've come down almost a full percent, 0.9%. It's at 2.275 today. But what I wanted to show you there is the red line and the green line kind of show us what normal looks like. If we got from 2.275 down to the high end of normal, that's more than 0.25% better in interest rates without any improvement in treasuries, which we are likely to get based off of the Fed cuts that are likely to come through the rest of the year. So we should continue to see a slow trend towards better rates. Before I show the next slide, Jeb, the blue line there that I put in there, Matt Graham was quoted in an article with Lance over at Resi Club, both of them great guys, really good analysts, and looking at this, but he said it's pretty reasonable to expect that we may not see a repeat of those really low levels of that 1.3, 1.4, 1.5 spreads. The new normal is likely to look like 1.8 to 2%. That's as good as anyone's guess,
Sure.
backed by facts. So I don't think we have a big glide path down to the 1.4 that was the low end of normal, but definitely we could get to 2 to 1.8 fairly easily. What Lance did is through this chart in here, these are the forecasts of what Fannie and the MBA show for the next 5 quarters, 1, 2, 3, 4, 5 quarters on 30-year mortgage rates and the 10-year treasury yield. And he calculated what that means for a spread. So Fannie has the spread in the fourth quarter dropping to 2.1, first quarter of next year to 2, down to 1.6 by the end of next year. That's pretty aggressive. That's below what we just said is likely to be that new normal of 1.8 to 2. The MBA, on the other hand, says end the year at 2.3. We're already below that, and basically stick at 2.2 all throughout next year. I bet we're under 2.2. I don't know if we'll get all the way under 2% next year, but we'll see how that plays out. Jeb, we redrew these back to your preferred measure of these really long trend lines going back like 5 years.
Mm-hmm.
So the rising trend line is the blue. The orange line is coming down. We are still converging. As of today, as of the last couple of days, we kind of poked out of the bottom of that lower trend line. We'll probably is a sign that we're gonna trend up in interest rates if we were looking purely at the technicals. But the fundamentals of what happens with CPI tomorrow will tell us what that is. If you look, another way of looking at these support and resistance levels is the chart there at the bottom. We broke through 4.12. As of today, we're at 4.049. So 4.05 is a resistance level. It's interesting, Jeb, that we broke through that the day before CPI. It's going to be a very important indicator of where the market goes from here. We also had a 10-year auction today that the 10-year auction actually went off at a lower yield than what the market was trading at prior to that, which is pretty unique to see that kind of a strength in an auction just the day before a really important piece of data. unless the market just truly feels like we're moving a little bit better in interest rates. I wanted to throw this one in here, Jeb, at this point, because you see rates have been trending down. This is the purchase index showing week over week. And if we showed this all the way back to like COVID, these bars are tiny relative to where we were. But I drew that trend line in there. As you can see, over the last year, purchase applications have been trending up. Rates in general have been trending down through that timeline. But we're back to the highest levels in the year. So people that say, interest rates don't matter, people aren't going to run out and buy houses because rates are 1/4 or 0.5% better, they are just wrong. Does this mean that we get to hot numbers, that we're going to have 5 or 6 million homes sell next year if we get to 5.99 on the 30-year fixed? It absolutely doesn't, but there will be more sales. And the charts that you showed at the top of the show, Jeb, bear that out. So what does it say where we're at? Mortgage News Daily has 30-year fixed essentially at 6.25, VA and FHA at 6%. We've locked several better than this. Important to remember, this number is 25% down, 780 and above FICO. So if you have a lower down or a lower FICO or a combination of those, you're likely to get a little bit worse rate. With the refinances, it's important that if you did 3% down, 5% down, and your home has gone up just a little bit, and we're doing a rate and term refinance, you may actually get a slightly worse rate. Coming through COVID, when appreciation was going up rapidly, people would be sitting at like 70% loan to value, 60% loan to value. So even without a perfect credit score, they would get the absolute best rates. We generally are seeing higher loan to value ratios because people have bought more recently with less appreciation and lower down payments. But it's a good indication of what you can get in rates. You would reference, Jeb, over 1 week, over 1 month, we've seen nice improvement. Interesting to know that rates were falling faster last year. So we are now actually higher than where we were a year ago.
Yeah. But as I mentioned earlier, like mortgage demand is the highest it's been in 3 years, right? That slight little tick down in rates created a lot of people coming to the table for refinances, a lot of people getting off the fence on the purchase side. So, the fall winter market's typically a slower time in the year. Last couple of years have been anomalies to that in some regard. And so, this year might be another exception to that seasonal trend that we become accustomed to being in the real estate business for a long time. But we will see. We will continue to watch it, continue to update you, and continue to answer your questions. Now, if you're currently in the market, you have a rate, you're trying to refinance, wondering when it's going to get down, what to do when it gets there, use jebsmith.net/rate watch. Get on the rate watch list. As rates come down, we'll reach out and help
Jeb,
you decide whether or not it makes sense.
I was thinking about this when we put the slides in there. For most people, it's worth a conversation. The rate watch, we did that when rates spiked up last year. So it's like, hey, rates probably don't make sense now. Get on there and we can reach out when they do. Use the jebsmith.net/start. Just start. Let's start with a consultation. Let's get a mortgage statement. Let's look at it. Let's run numbers today and say, hey, does the savings make sense? And if the savings don't make sense, we just plug in a strike rate and says, hey, if rates get to 5.875, you're in. If rates get to 6.04, you're in. We can set that and just be ready to go as soon as we hit those levels, assuming we do.
Again, link in the description if you need that. So, Josh, not really a lot of questions in the chat. We do have some regular viewers in here reaching out and saying things. We got Dixieland Production. We got Chris in here talking about my beard. Chris clearly does not pay enough attention to the detail because I've actually trimmed the beard back considerably, Josh. So much so that I actually jacked it up this morning on this side, and I thought this might be the end. I might have to go completely off. And then I realized, you know what? It is what it is. It'll grow back. I don't really care. And so we left it. And,
Chris has such beard envy that I'm assuming he's one of those people where it grows in patchy or real thin, and so he just likes that macho brawny beard.
Maybe like ZZ Top beard, and just looking for people to jump.
To people to join the club with him. That would be interesting. We may need a picture, Chris. We got to see.
Maybe a product. Maybe he sells a product that he's trying to push me. Wants me to have a beard. Then there's a product for me to buy and sponsor me. The whole thing. Anyhow, guys, now's a really good time to put your questions in if you have them, because there's not really anything in here to discuss. So if you're somebody that has questions about, the home buying process, maybe you're in the middle of it, maybe you're not, maybe you're just trying to get started, see if it makes sense. Now's the time to put it in there so that we can help guide you in the right direction. Mr. Lewis. So big news, guys, as we're chatting, tomorrow is CPI. That's going to get released at 5:30 in the morning, Josh? So by the time 5:30 California time, Pacific Standard, so 8:30 on the East Coast. And by the time most people start their day, we're going to know whether or not rates are in line or CPI is in line and rates continue this trend, or if we have some sort of regression and rates trend back up.
And here's the thing. I think it's important for you guys to know and remember they rarely go in a straight line. So if we had drawn the down channel,
drone.
If we had droned the down channel that we're in right now, it's perfectly normal that when rates are going down in a channel like this, that they'll trend down to the bottom of that channel and then go back up. And when they hit the top, it's most likely going to hold and they'll trend back down and go to a new low. So as long as you have lower highs and lower lows, that downtrend stays intact. We are at the far end of that range, so it would not be abnormal for rates to start giving back some of the gains we've got over the last 10 days or so.
Yeah, it's been a considerable move down. It's time to give some of it probably back. Not that we want to see that, but like a healthy market, there's a move in a direction, there's some pullback, and then there's the continuation of that move. And so it's probably somewhat expected, but selfishly, I hope that rates continue to go down and more people continue to benefit from that. Josh, there's a good question that we've answered a couple of times, but it's a good question. Why are jumbo rates, maybe explain what jumbo is too, better than say high balance conforming or conforming rates?
So Fannie Mae has their standard loan nationwide anywhere in the United States. It's $806,500 for 2025. We'll get an increase for 2026.
You think we're going to get an increase?
We will, because it's tailing off here. The year over year is tailing off towards zero. But our guy over at Calculated Risk, he ran the numbers. He thinks it's small, 1 or 2%, but 2% at 800,000 is $16,000 increase.
Sure, take it up to 820 or so.
It's a real increase.
No.
So in high cost areas, it can be up to 150% of that. So Orange County, where you are, Greg, LA County, 150%. It's $1.2 million and change that you can go to. So those loans go to Fannie Mae and Freddie Mac. So if you're looking at high balance, the reason why the jumbo often looks better is because there is, with anything less than 25% down, you end up with a 1-point hit for even now on purchases. It used to be refinances only, but even on purchases for a high balance loan. So over that 806.5. Why would jumbo loans ever be less than Fannie Freddie loans? Because they're harder to qualify for. Generally lower loan to value, generally higher credit score, greater reserve requirements. So they're not going into the secondary markets in the same way that Fannie Freddie mortgage-backed security pools are. But they may be held by a portfolio lender who has a lower cost of funds, is looking to meet different goals. So from that perspective, we've got options. So I know you want to kind of update the numbers because we've seen a nice downtrend while you guys have been out looking at properties, but we'll get you some updated numbers and we can kind of show you. And I think if I remember correctly, we did make that determination that for you guys, the jumbo is probably going to get you better terms.
All right, there you go. Josh, remind us how we know when it's potentially a good time to refinance.
The reasonable number, the aggressive number, depending on how high closing costs are in your state, take $125,000 and divide it by your loan amount. So if you have a $250,000 loan, $125,000 divided by $250,000, it's 0.5%. If you have a $500,000 loan, it can be as low as 0.25%. $1 million loan, it might only be 1/8%. Some of this does come down to how much does title insurance cost in your area, and are there mortgage taxes on the refinance? Some states you could have $1,000, $2,000 of taxes on the refinance, and you might have, instead of a $600,000-700,000 loan here in Southern California, we might be able to get your title insurance for $500 or $600. Other parts of the country it could be as high as $2,800. So we got to measure that. What are your costs? What's the monthly savings? What's that recoup? So if you're thinking about it, honestly, I'm only having about 42 of these conversations a day. So if you're thinking about it, reach out. We can go through the numbers. If it doesn't make sense today, the math is pretty simple, and we go, it would make sense at this number, and we'll be ready to go once it gets there.
We'll let you know when the maths. JebSmith.net/start. We'll get you there. Tom is asking a question. Can you be on a list of like a rate watch, Josh, if you're not under contract, you don't have a mortgage, you just want to see rates move down and you're kind of waiting for a special rate before you start the loan approval? Or is that the wrong way to go about it?
I don't recommend watching rates on a daily basis when you're not under contract, or even when you are under contract. Maybe from the time you get under contract to when you lock the loan, we'll look at it, but not on a day-to-day basis. So I know you're here every week, basically watching the show. We cover the rates at the top of the show. That's about as often as you want to check in. Don't obsess over this stuff. You don't control them. They're going to be what they are once you find the right home for your needs, which I know you have some specific needs, and it may take a little bit longer.
All right, good stuff. A little bit. I mean, we've addressed this question as well, but it's a good question. So TN asked the question: single family house versus townhome. So Josh, instead of answering that question, because we don't know TN like what they're looking for, let's just kind of go through the pros and cons of what it looks like on a single family home. Josh, maybe start with what are some of the pros of a single family home when you would compare it to a condo or a townhome, rather?
You can do whatever you want. You want to paint that thing purple, assuming you're not in an HOA. If a single family home that's not subject to CC&Rs with the homeowners association, paint it purple if you want. Put a pool in the backyard. Build on a second story. Any number of things that you can do with it. Those would be some of the pros. You generally are not attached to a neighbor, so noisy people can be problematic. Gives you a little more distance, a little larger lot size, a little more land. It's all relative. You know,
Sure.
you just here in our city, we have as little as 3,500 square foot lots for single family homes, and as big as 25,000, 50,000 square foot lots.
Yep.
Some parts of the country, the 50,000 square foot lot would be tiny. But what are you thinking in addition to those things?
No, I think those are a lot of the positives. I think, I mean, a townhome, what are the positives of a townhome? Townhome, a lot of times, the HOA, because they're going to have one, is going to be responsible for the exterior of the property, right? So they're going to take care of the maintenance of the exterior. They're going to take care of the roofs in a lot of cases of townhomes. In some cases, maybe your water, your trash is included in that townhome HOA.
Cable sometimes.
Cable as well. You might have community amenities. You might have pools and that sort of thing as part of the community that now that you're in that community, you have access to. And also, less expensive, right? A townhome is typically going to get you can probably get in a more prime location for less money than you would be able to do a single family home. So in that way, you can actually afford a little bit more home buying a townhome versus a single family home. Those are the positives. I think, also when comparing it to a condo, if we even want to go there, townhomes, you only have somebody typically on one side of you versus somebody above you and below you with a condo. So those are some positive things. Insurance is typically a little bit less expensive on townhomes because the HOA is covering a part of that property as well. Whereas a single family home, you're responsible for not only the interior of the structure, you're responsible for the outside as well, where an association would take that on in a townhome. So just kind of some quick things coming off the top of the head there. So it's all personal preference, right? There are some people that say, hey, listen, a townhome is perfect for me. I don't want the maintenance of a single family home. I don't want to deal with yards and all of that stuff. I want somebody to maintain it. I want to lock it up and I want to drive my RV across the country and know that my property is taken care of. And that's a good way to look at it.
It sounds awesome. You're selling me on it. I'm ready to go.
And there's other people that are like, that's a horrible idea. So I think, to each his own, do your research. If we can be of assistance, you can use that link in the description and we can talk through it in a little bit more detail.
And just know that there's degrees of all of that. Like the example that I'm using with that, Jeb, like our place out in the desert, it's technically a condo. We only have a neighbor on one side. We have yard on the other side. But the cool thing for us about that, we're not there full time. There's security. It's behind gates. Someone else handles the landscaping, the exterior painting, the roof, all those things you mentioned. So for a second home, that's wonderful. For someone like you said that hits the RV, that travels, that's retired, that can be awesome. For a young single woman that doesn't want to deal with yard work, that feels better about being in something gated, there can be any number of benefits. So there's this whole spectrum or continuum, not quite as simple as just SFR versus townhome.
Good stuff. I clicked on this one a moment ago from Robert and just asked, will there be any more major data to come out later this year that could have an influence on the Fed's decision to, say, lower rates? Josh, what do we got?
Really, so the QCEW comes out twice a year, and you saw it doesn't really move the market, but it's something the market looks at. We don't get the next look until the spring. So really, between now and the end of the year, what do we get? We have 3 more Fed meetings, so we have 3.5 months left in the year. We get 3 more Fed meetings. what is the Fed looking at? They're going to look at the jobs reports every month. So 3 monthly jobs reports with revisions each time, and 3 more looks at CPI. PCI is the Fed's preferred measure of inflation, but the market doesn't trade that nearly as
PCE.
much. PCE. What did I say? PCI? What the world
Yeah,
am I making? Am I making stuff up over here?
It's all
Jeb? I
good.
got my own
We have a
report,
new
a
term.
PCI
Yes.
report. So PCE is their preferred measure, but the market generally trades CPI because it comes out 2 weeks before that. And some of the figures that we get in a few of the other reports trickle into PCE. So pretty easy to reverse engineer and know what it's going to look like before it happens. So it sounds like a broken record. You're watching CPI every month. You're watching the jobs report every month.
You know, I almost made a comment about 2 minutes ago, Josh, that we haven't frozen at all. I don't think we
And then it
froze
starts
last
freezing?
episode. Yeah. And then we haven't frozen. And then all of a sudden you froze. And I was like, it's a good thing I didn't say that, because I thought as soon as I say it, it's going to happen. But anyhow, financial freedom asking a really good question that we've covered before. Says, is it worth it to pay off your mortgage early or invest that money into something else? Also says, rest in peace to Charlie Kirkland, as we mentioned earlier in the show. So, Josh, pay off your mortgage, invest it. What's the smarter move? What kind of return are you getting in this market?
Well, think about it. We've got 2 separate types of folks. If you have COVID era interest rate at 2.5%, 3%, I got a really hard time suggesting you kill that thing early. I would stretch it out as long as I can and invest elsewhere. Let's say you have a 6 or a 6.5 or a 7, 7.25. First of all, those folks should be looking to refinance. But in addition to that, do we want to pay the loan off faster? A couple things that we want to look at. How savvy of an investor are you? How comfortable are you that you're going to be able to achieve a rate of return greater than the interest rate on the loan? So that's one piece we want to look at. Where are you in your life stage? If you're 60 years old and you want to retire at 72 and there's 24 years left on the loan, we probably want to accelerate that. So we're looking at both, and you can look at it as an offset account as well. Say, hey, what I want to do is I want to pay this thing off as soon as possible. I'm in my prime work earning years. So people, the last 10 to 15 years before retirement are generally years when they make the most money and pay the most taxes. So the tax benefits of an interest deduction, if they apply to you, are good to have in that position. And you can just invest as heavily as you can and grow that as quickly as you can. And if we run the numbers, if we're just doing a pure math exercise, very hard to say what home price appreciation is going to do year over year, what market returns are going to be year over year. But you will generally be able to pay your house off faster by saving and investing and building up a nest egg that you can just write one check to get rid of your mortgage. But there's no right or wrong answer. The higher your interest rate is, the more it can make sense to prepay it.
There you go. Dixieland Production, always here, rarely ask any questions, but has a good one tonight. Says, what's the best way to leave the house to the kids when we reach the end of our road? So, the best way is a trust, right? You get to, direct, if you will, exactly what happens in there, percentages, the whole thing. I also recommend having healthcare directives, like everything, like have a plan for what happens to you in every facet of your life after you leave. It makes things a lot easier on everyone, even though you're gone. And so, I come across this often. Probate is a unnecessary evil, and those that have to deal with it on the other side, fortunately, haven't been in that position, but I have to deal with a lot of people that do have to deal with it, and it's a nightmare. So if you can direct it, there's ways to do it without a trust. They now have deeds that you can fill out and leave property and do different things so that it doesn't go to probate. But at the end of the day, if you want to avoid taxes and a lot of the other things that are one of the big benefits of being able to pass it on, a trust is really your best option. And I would recommend that for everyone, not just the people at the end of your road, so to speak. If you own anything worth any value, it's worth putting it in something so that you never know when your last day is going to be. I mean, honestly, like we take today, for example, like, you have your shit in order, if you will, and that way it makes the process a lot easier for people after the fact.
And most people are not aware of this. I would say at least many people, if not most people, are unaware that the best thing you can leave for your heirs, whether children, whoever, they inherit that property at a stepped up basis. we'll use a crazy example. I paid $580,000 for my house. Depending on where you're at, it's worth 3 times that today. And if something happens to me, I get hit by a bus, my heirs will inherit that home at a stepped up basis, which means that they inherited at today's value. They could sell it tomorrow and there's no gain there. There's nothing else that I'm aware of that you can leave your heirs that makes the tax consequences just go away. So, yeah, for
Yeah,
what
I
it's
mean,
worth.
and there are limits, like depending on how much assets you have. You know, we're
The
not talking
limits are
property here, but it's
astronomical.
they're big numbers. You have
99%
to
of the
have a
people
lot
that
of
we're
money.
talking, yeah.
But there are limits in how much you can leave without tax consequences, that sort of thing. We're not. I don't know that we're talking to them here. If we are, congratulations.
Congratulations. Good. Well done. Well done.
Yeah.
Appreciate you.
You were born into a good family, and good for you. Leonardo says, any thoughts on Newmark as a builder? I don't know Newmark. Josh, maybe you can speak to that. But another question says, currently under contract. Fear of missing out is getting me in upgrades. Is it worth it to do upgrades, Josh, if they make you happy?
So listen, there's a book we've talked about on the show here before, Die with Nothing. And it says the purpose of money is not to die with a bunch of money they throw into. And we're talking about the dying episode. We should just rename this instead of the buyer's market over the dying episode. The purpose that they're not going to shovel your things and your dollars and your bank accounts in the coffin with you when you go. So there's a balance there, right? We got to be prudent. We got to make sure we're financially secure. We're not putting ourselves at risk. But at the same time, for me, if I'm going to invest, we put a pool in. I did not get a dollar for dollar increase in the value of my home for that pool. But every time I come home at night, I look in the backyard and I see that pool and it makes me smile. So it's an investment in my happiness. So within reason, you can justify that because you're not going to spend more time anywhere. And for us, meaning me and my wife, we spend a lot of time at home. We like our house. We like being there. So the nicer it can be, the more you like it, probably saves you money. So you're not going out to dinner, going on vacations. You're just like, I like it at home.
No, and I mean, when doing, one thing I've learned in doing remodels and different things over time is that the upgrades you didn't make and you didn't do that you thought of, they do come back to haunt you in some regard because you wish you would have done them when you see other people that did them, or you realize that over time, that couple $1,000 here and there probably wasn't a big deal. And I think when it comes to remodeling new construction, you're paying more for it through the builder in most cases than you would to an outside vendor to do something similar. The benefit is you get to finance it into the loan versus coming up with the cash out of pocket. So if you got the cash, by all means, do it after the fact. If you don't and you want the upgrades, doing it through the process is a good way to do it. Right now, new construction, I mean, there's probably some incentives that they're offering where you can use some of that money towards those builder upgrades. But I don't think it's a horrible idea, but I also don't think you need the best house in the neighborhood either. So somewhere in between, I think is a good place to be. Josh, what do we got? Iba Tui?
It's YouTube backwards.
Oh, YouTube backwards. Yes. That
backwards
YouTube.
YouTube.
Backwards. Yes. I like Iba Tui. I find it hard to believe that Fannie and Freddie believe that the 30-year fix will be in the 5.8 to 6% range in 2026. That seems really high. They actually don't even think those numbers, actually. Those are low compared. Fannie Mae is expecting interest rates to be at 6.1 by the end of 2026. Which is essentially where we are now.
Where we are today.
I mean,
this is a case, Jeb, of once bitten, twice shy, or 5 times bitten, twice shy. They've put out numbers. We've talked about it 2 to 3 times on the show where, hey, by Q3 2025, rates should be 5.5. And yet here we are sitting at 6.1. I think they've got tired of the blowback of, hey, you're stupid. Your economists are dumb. The numbers are wrong. And they just put out a real conservative number and go, hey, time will tell. We will see.
Yeah, I mean, at the end of the day, what do they got to lose? I mean, we're putting it out there and now we're changing it. People have short memories, dude. They don't remember anything. We've been talking on here for 5 years about home prices not crashing. Nobody remembers that, Josh. They think we're the doomers. They come on and like, you guys are talking about prices crashing. No, you idiots. We were the people talking about prices not crashing. Anyhow, Platinum Black has a great suggestion, and I agree with platinum black on this. And people are like, you're crazy. And I would have said you're crazy until internet speed. So the comment is have them run Ethernet to every room before they put the drywall up. Chances are builders not going to do that. They have a lot of these builders do it anyway, right? They're running Ethernet everywhere. But I wish I had Ethernet in every room of my house now. And it's not something I ever wished, because Wi-Fi has always been great. But what I'll tell you is that now that the speeds are like blazing fast, and you can just, when you can plug in, it's a night and day difference from Wi-Fi. Even if the Wi-Fi is fast, it's crazy fast with when you're plugged in directly Ethernet. So,
well, it's weird, Jeb. I'm plugged in directly to this computer, and yet we freeze 3 times an episode. We have the magic.
Sucks.
Yeah.
So this place is different, but I think Frontier, which was Verizon, depending on where you are, different fiber optic.
It was awesome when it was Verizon. It sucks now that it's Frontier. That's to you, Frontier.
You're not wrong. You're not wrong. But I've got 2 gig internet at home. They have 7 gigs now, dude. It is like, when I'm at 2, I'm like, how can this get any fast? I don't even know what 7 would do. Like, we could stream the show from anything. Like, we'd be solid.
I remember the first time we got like 1 megabit through the cable modem, and you're like, this is amazing. This is amazing. I can watch a 3-inch by 3-inch video and it's only semi-grainy. This is amazing.
It is pretty wild, right? And I was actually talking to my wife earlier today about how if you use ChatGPT or any sort of AI, how it is the most fantastic, upsetting, just piss you off thing that is ever been created, that makes your life a hell of a lot easier. And what I mean by that is, even at its worst, it makes life so much simpler in doing just minuscule and sometimes mundane tasks. But it will go off the rails. Like, it will do things right 100 times, and then the 101st time, it acts like it has no idea what it's doing and just decides that, we're not doing that anymore. I was wrong all of those other times. But then you tell it it's wrong, and it agrees with you. And I told my wife how I talked to it, and she was like, visibly, like, she didn't understand. Like, when I get mad,
because she uses it. Hey, I need a lasagna recipe, and it gets that right every time.
Yeah, I'm like, no, I talk to it like, what are you doing? Like, obviously in different ways. And it's apologizing to me. And she didn't get how, like, I was having a conversation with the AI. But anyhow.
All right, Jeb, we got a trick question for you.
Yes,
Robert Carmona is back. Rather, Corona, not Carmona, is back. Who do you find better value in, Alex Hormozy or Tom Ferry for coaching?
It depends on what you're going for. Here's the thing. Tom Ferry, great real estate coach, been around a long time, understands the marketing piece of the puzzle when it comes to real estate. Alex, I feel like, is very smart, just in general, very philosophical, just has some really keen insights on just life in general, which I think is fantastic in how he views things. But I think he can also be very almost too in depth for most people out there when he talks about how to scale things and how to do certain things, and takes it to a level that most people can't comprehend and will never get there. It's one of those things where he's going to give you so much information, you're never going to do anything. Whereas I think a Tom can start you with the basics, and then you can build off that.
So
what are your thoughts,
Jeb,
Josh?
The numbers, I don't have them here in front of me, but School. So Alex is an investor in School. So after his most recent book launch, they 6x'd their subscriber base. They went from like 30,000 subscribers to 180,000. Mm-hmm. So of those 120,000 new subscribers, how many do you think will ever do anything with School? The number will be closer to 0 than it would be to 1,000 or 2,000. So does that mean that he's an idiot and a shyster that he sold you on this? No, you can build an awesome community in School. Sure. But the fundamentals, the things that he's teaching will absolutely work. You are probably not the person who can execute them. So know yourself and know what you are willing to do.
And we're not talking to you directly, Robert. We're just talking in general.
Just in general, because all of those people, they're going to pay for School for a year or two. Alex is going to get rich off of that. And again, I'm not saying he's setting you up. What he's telling you will work, but you're probably not that person that's going to execute it.
If I were you, Robert, and I was considering coaching, I would be considering like Tom versus Brian Buffini, like that sort of thing. Like that's where you say, okay, who is who is right for me based on their philosophy, how they teach things, that sort of thing. Hormozy is just a coach in general. He's telling you how to scale things, which is completely different than just understanding real estate in general. So just two different people entirely, both good at what they do. But yeah, I think you can find more value in one versus the other. Is California considered a buyer's market or a seller's market right now, Josh?
Depends on where you're at and what price point. If you're buying a $4 million home, it's probably a pretty good buyer's market. If you're buying a $600,000 home, all of my buyers that are in the entry level, whatever that may be, some areas entry levels 1.2 million, some areas it's 450,000. But anyone that I have that is an entry level buyer, they're having a fun time. The lady we were talking about last week, a viewer of the show, I think we're on 7 offers in that 700,000 price range in LA County. There's a lot of people in that price point. And any nice homes are getting a lot of activity.
Yeah, it's inventory is still the problem for most people, especially in if you're under the median price point, it's still tough. It's definitely a seller's market. Pretty much all of California. As you start to creep into those higher price points, could be considered. I'm sorry. Did I say buyer's market? I meant seller's market earlier. As you creep into the higher price points, could be more of a buyer's market. But even then, to each his own, right? There's still some of those properties that sell immediately, some that sit a little bit longer.
And I will say, Jeb, we talked about those 2 in my neighborhood. Very nice flips. I say very nice. Someone bought both of these homes in my neighborhood. They're very large homes. They did very nice interior remodels. And if you drive down the street, it looks like any other house in the neighborhood because they didn't touch them on the exterior. And they're pricing them like it was completely renovated inside and out. And they both have had price cuts. I think they're both down about $100,000 and they're going to end up getting a couple hundred less. So does that make it a buyer's market for those folks? It probably does. You're probably going to end up getting a good deal as a buyer, especially relative to what those people thought they were going to sell the home for. But they're not tremendously cheap. They're still going to sell for the high end of what our neighborhood is.
Joyce has a question. Then we're going to jump into the question from the Vape King. We've been waiting. We've been waiting.
Well, he asked a question and then
hold on.
answered.
We're not going there yet. We're not going there yet.
Okay.
Joyce wants to know if a ton of people are reaching out to refinance now, Josh, after the disappointing jobs report.
So I can say we are spectacularly busy. I've been here till about 8:30 or 9 o'clock every night and at my desk by 7:30, 8 o'clock in the morning, hammering numbers. Probably the best example I can give you. This isn't not going to give you a lot of context, but United Wholesale Mortgage, the biggest lender in the country, locked $2.4 billion of loans yesterday. That's a shocking number for a month for most companies. So to do that in a single day, there are a lot of people out there taking advantage of the lower rates.
There we go. Okay, so the Vape King is asking a question. How do we get a housing shortage with a declining population? Single more, dividing the family. Okay.
When you start with a false premise, any answer is going to be wrong. We do not have a declining population. So there's the easy answer. We do not have a declining population.
It's just not growing at the rate that it was, right? Is that what we're getting to?
Correct.
Okay. So we don't have a declining population. We have a population that's not growing at the same rate, which essentially is kind of like house prices, right? House prices aren't declining. They're just not growing at the same rate they were. They're still positive year over year for most areas. But with that said, Josh, how did we get in a housing shortage to begin with? What got us to where we are at the moment?
So it would be funny. You might know the numbers, Jeb, but in 2008, did we have an excess? We had an excess of new homes. Builders just hammered and built all the way through the last housing crash, the only housing crash we've ever had on a national basis. So at that point, we may have had more homes. But since then, we've underbuilt for any number of reasons since then, as the population has steadily continued to grow, even though at a slower rate. So you underbuild for 17 years, it's what happens.
Sure. That's the easy answer. John, another question here. How are flippers doing in this market? Flippers, I think, are still doing, I actually didn't click on the question. Flippers are still doing well, I think, if they buy at the right price. Flippers will always do well if they buy at the right price, right? I mean, there's always a market for flips, regardless of the market, if you get them at a price that you can do repairs and put it back on the market and sell it. So, but I will tell you, I get messages, calls, texts every single day from people looking for opportunities out there. every single day. So the market is obviously still very, very strong here locally. I think that's probably for most areas out there, probably pretty similar.
And to your point, Jeb, those two in my neighborhood, the one right down the street from me, they overpaid. I'm like, I looked at them like, I mean, good luck. You're never making a bunch of money off of that. If you make $50,000 on a $2 million house, you're going to be lucky. The other one around the corner, they got it for like $300,000 less. You make the money on the buy. So if you're able to get the right deal, you're going to be fine. Those people have a lot of room to cut their price and still have margin in it.
There you go. Good stuff. All right. So on for 54 minutes so far. You know, guys, we've been doing this for almost 5 years now, the lives. Can you believe that?
Did you go back and look? Because I think it's longer.
I have.
I think it's longer.
So? Let me see when I did the first live. So that I'm not quoting, I'm not just making up things. I'm not Reventure Consulting. Hold on. I'm not just making up numbers.
Maybe if it helps you tell the story you want to tell, you should just make it up though.
Well, I mean, that's good. I like that. Let's go back here, Josh. How many lives do you think, I'm going to say I've done, because some of them you weren't on there, but how many lives do you think that I've been a part of on this channel?
A lot.
247.
247. So I don't see the date on this one, but
I'm going back here.
5 years ago, I'm on your channel. 5 years ago, it just says 5 years ago. So it was probably a little more.
June 25th, 2020 was the first one. And they've been almost every single, actually starting August 12th, every single week going forward since then. That's a lot. That's a lot, Josh. In fact, you were on the first one. You were on the first one. You've been in a lot of them. Your big head's in a lot of these thumbnails. So with that, guys, we've been here a long time. If you find any value, hit the thumbs up. Consider subscribing to the channel if you haven't done so. After 5 years, if you have not,
didn't want you to go look it up. He said, I believe it's 6 years. He answered before you even went and looked.
There you go. So it's 6 years. It's not 6 years though, because it's with June 25th, just over 5 years. I mean, just saying. But you gave us an extra year. We'll still be here next year.
He rounded up.
We'll still be here next year. But there is a super chat. Says I locked in my 2.5. I locked in my rate 2.5 weeks ago, 6.35 with a 670 FICO to close next month. Was it the right move, Josh?
670 FICO, 6.35 2 weeks ago. You're paying for it. So it certainly wasn't a 0 point rate. I mean, today you might be getting close to that with a 670 FICO. So need to know more details. If you want to send over the loan estimate, you can use the link below to get connected with us. Happy to look at it and tell you where it falls in. But I will reiterate, have another listener to the show that I'm talking to at 2 o'clock tomorrow. She's getting numbers from us. She got numbers from the lender that did the loan for her, and she sent that over to me today. And one of the things is, well, if we pay 2 points, we can get you this. Please, dear Jesus, whatever you do, do not trade 2% of your loan amount of your home equity to buy a vanity interest rate. If you've been here for any period of time, you know we strongly advise against that. It is always worked out for our clients to manage the process and keep the costs of your refinance down. So if you have a loan estimate from another lender and you want us to look at it, trust me, we are busy enough that we're not trying to steal loans from other folks, but 2 out of 3 that I look at, they are not in any way properly structured to put you in the best financial position over the long haul. I had another listener reach out today, Jeb, a veteran down in San Diego, and we're going through the numbers. Went back to the lender that did the loan for him, and they're paying a point for a 5.25 rate when they could do close to no cost at 5.5. The difference in cost was $8,000. The difference in monthly payment was $40. If you ask someone, hey, would you give me $8,000 to drop your housing payment $40? Most people are going to tell you to go pound sand. But it's just in how the information is presented to you. You are a smart person. You can make the best decision, but you have to have someone run through the numbers for you and show you what that looks like.
I mean, here's the thing. I'm only clicking on this comment because I have clients that are named Chris and Maggie. So this could be my clients. If it is, hello, Chris and Maggie, or Chris or Maggie, whoever here. But anyway, but it says house prices are going to skyrocket. You know, I mean, if interest rates come down in a meaningful way, you could see them continue to increase. This is a good question, Josh. I'm a betting man. You're not so much, but are you taking the over or under with 4.25 million home sales in 2025? So I think right now, annualized, we're about 4 million, just over.
I don't see how with 3 months left in the year, unless rates dropped under, got a 5 handle on them pretty quickly here, because I mean, as crazy as it sounds,
250,000 home sales.
it's 250
Close.
extra above and
Yeah,
beyond
sure.
the pace that we
Oh,
have
yes,
over the
exactly.
course of
Yes.
3 months. So there's just not enough time, because a lot of those, most escrows close within 30 days, but there's 45 and 60-day escrows in there as well. 60 days puts us down to November 10th. So we just don't have enough time left.
So
in the
clarify,
year.
you're taking the under.
Taking the under.
I'm with you. I would say the under's a safe bet.
I would say
under as well.
4.25 would be the ceiling. Like, if it
Sure.
does that, we have a really, really busy fourth quarter.
There you go. I would love to see it. I mean, I'd love to see 6 million right this year, right in the next 3 months.
I wouldn't get to sleep and I might die.
Just
But
fantastic.
hey,
I think it'd be great. Let's see. Good question here from Raul. Says, can you switch lenders in the middle of a transaction?
you absolutely can. Probably the more important question is, should you? And let's talk about a purchase transaction, which is much more time sensitive. We have a finite end to it. So with that, I have people regularly reach out, hey, just got a property under contract. I got 28 days till we got to close. I'm hoping to make a lender decision here in the next week. That is not the right way to do it. You should have made your lender decision before you put a home under contract, because you are relying on one of those lenders to help you get that home under contract with pre-approval letters, following up with the listing agent, assuring them that you can meet timelines, helping your agent write the contract to maximize your odds of getting that home. Don't use someone to do the hard work and then go, oh, I need to get the lowest interest rate. You can do that work, that due diligence ahead of time and make sure you're in place. But let's say you get 10 days into a 30-day escrow and you got 20 days left and you find they're just falling on their face. They're lying to you. They haven't delivered disclosures, haven't got the appraisal ordered. Can you pitch them overboard? Yeah. With 3 weeks, you probably have enough time. I have people regularly that will reach out, hey, I got 8 days. I got to close. Can you save me? Probably not. You're at risk of losing that transaction if you can't get an extension. Now we're in refi season because rates have dropped. On a refi, you can do whatever you want. What I would say is just the example for Bleed Green, locked 2.5 weeks ago at 6.35. If that was a great rate 2.5 weeks ago, and you go, oh, rates are lower, I'm going to go switch to a different lender because rates are better now. You wouldn't have liked it if they had gone and said, oh, your locked rate, we can't honor that. So I would expect you to honor them with your business. Now, in that same situation, if we look at the structure and the structure's all wrong and you're paying 2 points for a vanity interest rate and there was 14 different better ways to do it, and it's not just market movement, then you can change pretty much anytime you want. But respect the professionals that you're working with, assuming they're doing a good job for you. There is a tiny subset of people out there that are just assholes and they think they're the only important person in the world, and that it's okay at the 11th hour to just go, cool, you did 90% of the job, I'm doing X, Y, or Z. But what happens more often, I said that's a tiny percentage of the public, more often we have bad actors in the mortgage and real estate industry that drop the ball on you, and it is perfectly reasonable to make a change.
All right. If you need assistance, jebsmith.net/start, whether you're looking for a lender, looking for a realtor, reach out. Until next week, guys, buy right, borrow smart, build wealth. Adios.
Amigos.